It started with insurance premiums jumping 30 to 50% overnight. Then State Farm and Allstate abandoned thousands of California homeowners. By September 2023, the governor stood before the cameras and called it, "The housing market is in crisis." For first-time buyers and seasoned investors alike, the dream of owning in California now means facing median prices near $875,000, a 15% affordability rate, and a wave of property insurance cancellations in wildfire zones. That's just the tip of the financial iceberg. So how did America's Golden State end up on the brink? And what's forcing families to choose between their home and their future? The unraveling begins now. September 2023, the governor's order hit the wires before dawn, blasting through headlines across the state. Inside the Capitol, frantic calls bounced between county supervisors, legal counsel, and the largest insurance carriers in the nation. The message was clear. California's housing market was facing a threat it could no longer contain. Within hours, State Farm and Allstate confirmed what thousands of homeowners already suspected. Their withdrawal from California wasn't just a rumor, it was policy. Non-renewal letters stamped with phrases like catastrophic risk exposure landed in mailboxes from Napa to Butte County. Some arrived just months after families finished rebuilding from the last fire. For many, it was the second or even third rejection in as many years. Premiums that had already crept upward now rocketed higher. In wildfire zones, rates jumped 30 to 50% overnight. Paradise Ridge Estates, once a symbol of hope after the 2018 Camp Fire, became a case study in financial whiplash. Rebuilt homes, cleared brush, and upgraded roofs did little to sway underwriters. The new logic was simple. If a zip code appeared on the latest risk map, coverage could vanish without warning. Homeowners scrambled for alternatives. The state's FAIR plan, long considered a last resort, saw applications surge. Its own premiums climbed, and coverage limits left many exposed. Meanwhile, rebuilding costs soared, 30 to 50% higher than pre-fire estimates, thanks to stricter codes and material shortages. Inside insurance companies, the calculus was cold. Loss ratios in high-risk areas blew past 100%, with some portfolios topping 150. Internal memos circulated warning that staying in California without regulatory changes was unsustainable. Underwriters agonized over the fallout, knowing each non-renewal meant another family left to face rising debts and uncertain futures. By the end of the month, the governor's declaration was more than a headline. It was a signal that the rules of home ownership had changed overnight. For tens of thousands, the safety net was gone, replaced by a scramble to find any coverage at all. The shock waves would ripple through every open house, every mortgage application, every family still hoping to hold on into their piece of the Golden State. A young couple, both public school teachers, scanned real estate listings in Sacramento. Every new alert brings the same sticker shock. The statewide median home price now sits at $874,290. For most Californians, that number might as well be a locked door. Only 15% of households can qualify for a median-priced home. The income needed to buy, $222,000 a year, nearly triples the state's typical household earnings. In San Mateo County, the situation is even starker. Just 12% of residents can afford the local median. The numbers tell the story. The dream of home ownership is slipping further away with each passing season. Open houses fill with hopeful faces, but the math rarely works out. Mortgage calculators spit out monthly payments that outpace take-home pay before property taxes, insurance, or HOA fees are even counted. In some neighborhoods, buyers face not just high prices, but also steep special assessments, tens of thousands of dollars to fund wildfire defenses or infrastructure repairs. HOA fees, once a minor line item, now rival car payments in many communities. Each new requirement, fireproofing, seismic retrofits, water conservation upgrades, adds another layer of cost. First-time buyers are the hardest hit. Many watched as prices doubled over the last decade, then kept climbing. Even as some markets saw modest corrections, rising interest rates and insurance premiums erased any relief. For those who managed to scrape together a down payment, the list of hurdles grows. Stricter lending standards, competition from cash investors, and the ever-present risk of new fees or coverage gaps. The affordability index, once a routine market stat, now reads like a warning label. In county after county, the gap between what people earn and what homes cost keeps widening. The pressure pushes families to the edge, forcing tough choices about where to live, how much to sacrifice, and whether to leave California altogether. For many, the promise of a stable home feels more distant than ever. In California's largest cities, the road to new housing is paved with obstacles. Zoning boards, often wary of change, hold marathon meetings where even modest apartment proposals can stall for months. In Los Angeles and San Francisco, the average wait for permits on multifamily projects hovers near 2 years. Developers submit plans, revise them for environmental review, and then wait while neighborhood groups file appeals or demand concessions. The result is a bottleneck. Homes needed today are tied up in paperwork until 2026 or later. Local officials defend the process, citing safety and environmental standards. But for would-be buyers, the effect is clear. Fewer homes get built, and those that do arrive with price tags inflated by years of carrying costs and legal fees. The shortage is most acute along the coast, where land is scarce and opposition to new construction runs high. Inland timelines shorten, but the supply gap remains. Behind the scenes, planners juggle limited staff and a backlog that stretches budgets thin. The state's own reports admit that delays of 18 to 30 months are common for larger projects. Housing advocates call it an artificial chokehold, one that keeps supply perpetually behind demand. Meanwhile, nearly 2 million homes sit in high or extreme wildfire risk zones, yet new construction in safer areas lags, fueling competition for what little inventory exists. Layered on top is California's tax legacy. Proposition 13, passed in 1978, locks in low property taxes for long-term owners, while newcomers pay full freight. In practice, this split system discourages turnover and pushes the tax burden onto recent buyers. A family moving into a modest home today faces a tax bill several times higher than their neighbors next door. For local governments, the incentive is to favor commercial development or luxury projects that promise more revenue. For the average buyer, it's another hurdle in a market already defined by scarcity. These constraints didn't start with the insurance crisis, but they set the stage for its impact. When insurance companies began pulling back, the market had no cushion. The shortage of homes, the weight of taxes and fees, and the ever-present threat of wildfire exposure all converged, leaving Californians with fewer choices and higher stakes every year. By early 2025, the tally of insurance non-renewals in California had reached 2.8 million. Each letter delivered the same verdict: too risky, too expensive, or simply not worth the gamble. Homeowners in wildfire corridors, coastal bluffs, and even suburban enclaves found themselves swept up in a wave of cancellations that spared neither the wealthy nor the working class. Los Angeles County alone accounted for over 500,000 drop policies. In Pacific Palisades, hundreds of families rebuilt after the last fire, only to lose coverage again before the next season even began. Inside the state's insurance department, Commissioner Ricardo Lara faced mounting pressure. Internal emails captured the urgency, staff flagged the rising count of non-renewals, and legal teams drafted emergency orders late into the night. On January 7, 2025, the Department of Insurance imposed a 6-month moratorium on all pending cancellations in wildfire-affected zip codes. For thousands, this was a temporary lifeline. For insurers, it meant a forced pause on risk management strategies they considered essential to survival. Behind the scenes, underwriters at State Farm and Allstate debated the ethics of their own withdrawal. Internal chat logs from the Woodland Hills wildfire desk revealed a staff divided. "We're pricing people out of their homes, but the models say we can't stay solvent." One manager pointed to a 150% loss ratio in key fire zones, warning that the numbers simply didn't work without more flexibility from state regulators. Others worried about the human cost. Families left uninsured, entire neighborhoods exposed. The state's market of last resort, the FAIR plan, strained under the influx. Its assets doubled in a single year, but so did unpaid losses and unearned premiums. The plan's own actuaries warned that a single catastrophic fire could wipe out reserves and trigger billion-dollar assessments on every property insurer in California. In industry boardrooms, executives weighed whether to absorb the costs or seek permission to pass them on to policyholders statewide. Moratoriums offered a brief reprieve, but confidence in the private insurance market continued to erode. Each new round of regulatory intervention brought fresh uncertainty. Would coverage return, or would even more companies exit once the freeze lifted? For homeowners, the message was clear. The rules of risk had changed, and no zip code was truly safe from the fallout. Across the state, HOA fees that once covered landscaping and pool maintenance now bankroll fireproofing, seismic retrofits, and water conservation upgrades. For retirees on fixed incomes, the shock is acute. Some see monthly fees rivaling their mortgage payment. Mandatory building codes add yet another layer. In wildfire zones, the cost of rebuilding to code runs 30 to 50% above pre-fire estimates. Homeowners who thought they were prepared discover that every new requirement, defensible space, ember-resistant vents, double-paned windows, comes with a price tag. Each added expense pushes the dream of stability further out of reach, leaving many to wonder how much more they can absorb before the next bill arrives. Paradise Ridge Estate sits quiet again. After the campfire, families rebuilt with hope, cleared brush, installed metal roofs, met every code. But by spring 2024, insurance rejection letters arrived in clusters. Some residents kept journals tracking rising debt and sleepless nights. A retired nurse wrote, "We did everything right and we were dropped again. What's the point?" Mortgage payments stacked up alongside therapy bills. Local support groups filled with stories of depression and decisions to list homes for far less than they cost to rebuild. In Napa, a March HOA meeting turned raw. Board members announced a $65,000 wildfire assessment per unit demanded by their insurer for hardening upgrades. The room erupted, shouting, threats of lawsuits, resignations on the spot. One couple on fixed income faced a choice between draining retirement savings or selling quickly. Across California, HOA fees that once paid for landscaping now bankroll fireproofing and seismic retrofits. For many, monthly dues rival mortgage payments. The pressure isn't contained by state lines. In Phoenix, deed transfer records show a sharp uptick in California buyers, many arriving after non-renewals or unaffordable premiums. In 2024, Phoenix home prices jumped 7%, with bidding wars erupting over modest ranch homes. Local agents report first-time buyers getting outbid 3 or 4 times in a row by cash offers from out of state. Arizona realtors say you can spot the California offers. They're 10% over asking, no contingencies. Behind every statistic, every canceled policy or surprise assessment are families recalculating their futures. Some stay and fight. Others pack up for Nevada, Arizona, or Texas. The migration wave is more than numbers. It's a story of hope, frustration, and the search for stability in a market that keeps rewriting the rules. The California Fair Plan's financials now read like a warning label. In just 12 months, admitted assets jumped from $678 million to $1.43 billion. A 110% surge that mirrors the rush of desperate policyholders into the state's last resort pool. Net premiums earned soared to $662 million for fiscal 2024, up more than 50% from the previous year. But behind the headline growth, risk is stacking up even faster. Unearned premiums, the money set aside for future claims, ballooned from $491 million to $825 million, reflecting a tidal wave of new obligations. Plan executives point to rising net income and a rebound in members' equity, now at $374 million after a deficit just 2 years ago. Yet with unpaid losses quadrupling to $126 million and reserves stretched thin, the numbers suggest exposure is outpacing any sense of security. For the Fair Plan, rapid growth is less a sign of strength than a symptom of deepening market strain. Lawmakers now face a choice that could reshape the market for years. At the Capitol, hearings stretch late into the night as consumer advocates and industry lobbyists square off over how to handle the next round of insurance assessments. On the table is a scenario where the Fair Plan triggers a $1 billion industry-wide assessment after another catastrophic fire, with insurers pushing to pass as much as $500 million of that cost straight to policyholders. Proposals to overhaul Proposition 103, California's signature insurance regulation, spark heated debate. Insurers warn that unless they can use modern catastrophe models to set rates, more exits are coming. Consumer groups counter that relaxing the rules could send premiums skyrocketing for millions. For buyers and owners, the outcome of these battles will decide whether insurance becomes a manageable cost or a deal breaker in the years ahead. In September 2023, Governor Newsom declared a housing emergency as insurance premiums soared by 30 to 50%, and major insurers like State Farm and Allstate stopped writing new policies in California. The documentary has shown how a decades-long shortage, restrictive zoning, and wildfire risk pushed the median home price to $874,290, leaving only 15% of households able to afford a home statewide. 2 million homes now face high wildfire risk, and over 2.8 million insurance policies have been non-renewed or canceled. While state agencies imposed a temporary moratorium on cancellations, the long-term stability of the California FAIR plan remains uncertain. With assets doubling to $1.43 billion amid proposals for billion-dollar assessments, many homeowners now struggle with rising taxes, HOA fees, and mandatory repairs, and some are forced to leave the state. Despite reforms under debate, no clear solution has emerged. The crisis is ongoing, and as of early 2025, key decisions about insurance reform and housing supply have yet to be made. The evidence shows California's housing market stands at a critical crossroads.